This is a video on reversal patterns using Technician software. Let's start with the obvious, that markets go up, they go down, or they stay the same. Technical patterns that form on the charts are grouped into categories that fit this. For example, in rising and falling markets, the shapes that bars, candles, pointing figure columns, or whatever form over time are called continuation patterns for obvious reason. The trend stops and then it continues. In flat markets, they are simply called trading ranges. But when markets are about to change direction, the pattern is then referred to as a reversal pattern. And here's how we can tell the difference. Most technical patterns form when the market trades in the same price range over several time periods, whether it's minutes, hours, days, or whatever, and the bars or candles temporarily stop trending in either direction and tend to bunch up in a small region. This is called congestion. The shape of the zone, the congestion zone, gives a technician clues on where the market will head next, either in the same direction or the opposite direction. Once that shape has been determined, the technician waits for confirmation in the form of a breakout from the zone, prices leave the congestion zone, and possibly additional confirmation from a technical study such as momentum and RSI, stochastics, or something else. On the chart here we see a head and shoulders pattern. Only this time it's just an upside down or inverted head and shoulders pattern because it's coming at the end of a decline. The pattern is named for somewhat of a resemblance to a head, which would be the peak in the rising market, surrounded by two lower peaks called shoulders, and the neckline would run through the reactions between those peaks. In this case, we're looking at the opposite, so the reaction between the lows. That's called the neckline. I know it looks like it's coming across the shoulder, the chest, but that's what it's called. What's going on here is that the market is in transition. Indicators are likely changing or slowing down. So in this case, downside momentum would be waning. You might see indicators starting to set higher lows. So for the head and shoulders pattern, what we see here is continuation of the existing trend. So it sets a lower low and then corrects with a little rally, and then sets the final low, which of course we don't know at the time, with another rally, and then the first time it sets a higher low, which is the right shoulder. Now this particular right shoulder is a little complicated, but you can still see that it touches the neckline here and then makes a significant or recognizable low here, before once again coming up again, finally breaking out. And when it moves above the neckline, that's when we know the pattern is completed and the trend is most likely reversed. So let's summarize. In this particular pattern, momentum likely starting to rise. Price failed to make a lower low in this case. It came up and made a reasonably similar type of high, which would be this point, these points here on the neckline. And then the breakout is a buy signal. And of course it has to stick, but that's the way it is with any pattern. So it's important to note that we use several technical indicators, including momentum, including perhaps volume, trend breaks, moving average changes, things like that. So it's not just the pattern that we're looking at. You need confirmation with other indicators to give you a better idea of what's going on. Because you could make a case that over here is the bottom of the triangle pattern, and that might have a different meaning. So that's why you want to confirm with other indicators. Another type of reversal pattern, which is really just a variation of the head and shoulders, called a double top or a double bottom. In this case, we have the US dollar index with a double top pattern. You can see it makes twin highs at pretty much the same price, a double top, and it takes the shape of an M. Now again, in this example, it's kind of a complicated one where you have two dips in the middle, but overall you have a high, a dip, another high or a similar high, and then back down to the bottom at support. And then the breakdown would be your sell signal. Now in this particular case, since we have a double low in the middle, we get a better support level to watch, and the breakdown from there gives you a better sell signal. So one important difference between this and, say, head and shoulders is that the head and shoulders might be more dramatic is also less strict in its definition. The neckline need not be horizontal, but it can be on an angle. A double top and bottom requires that it is based on a true support or resistance level. So remember, chart patterns by themselves can be misleading, and most require confirmation before we can trade. Often patterns that are traditionally considered to be continuation patterns, such as triangles and rectangles, can become reversal patterns under the right conditions. How can we tell? The honest answer is we cannot, at least not until the market makes up its mind and breaks from the pattern one way or the other. We can get indications with indicators, potential shapes, and maybe moving average type of changes, trend line changes, things like that. But you still have to wait for the market to tell you what it's going to do with an actual breakout. In this case, patience is a trader's best friend when it comes to patterns.